Good morning again from Policy and Profits. I'm Anthony Esposito of Island Capital. Thank you very much for being here. I'm joined today once again by EJ Antoni, Economic Mastermind, the policy side of the program. EJ, how are you today?
Anthony, I am hanging in. Actually, not doing too bad considering all the turmoil in the market the last couple of days. How about you? How are you riding this wave?
We're doing really well. I actually wrote my morning note today, and I clipped a piece of the note from December 23rd, which I'm actually going to take a moment now and put, I won't even bother. So I clipped a piece of the note from December 23rd and actually almost verbatim said the December 28th move, the December 18th move we saw down was the beginning, not the end of a greater move down, which I saw accelerating throughout Q1. And that has been extremely accurate. The model has been extremely accurate. We're actually up about 12% year to date at this point versus the S&P, which is melting like the Wicked Witch with a bucket of water over our head. So we're doing well. I'm very happy. We called about 3 weeks ago to be long vol and short the S&P, and that trade has worked tremendously. So very happy to hear it. I did want to ask you, very happy to be here and to be in that position. As we get into the show, I know we had talked about 2s and 10s in the past and that kind of inversion and then reset and re-inversion. Is this something you're looking at? Because I've had a couple of people ask me about it. I'm trying to watch it. Honestly, top down, is the 2s, 10s inversion something that we're looking at now or should be focused on for clues to the next leg down or up in the market?
Oof. All right. It's a really, really good question. The problem that we're dealing with right now, Anthony, is so many of our traditional indicators, frankly, they've just been shot all to hell. And some of that has to do with all of the changes to the economy coming out of COVID. It was such an unprecedented time. The government response was so unprecedented, right? But then also we've had unprecedented manipulation of markets, whether it's on the Treasury side, or on the Federal Reserve side. The violent swing we've had in interest rates. The Fed never held rates so low for so long and then raised them so quickly thereafter. And on Treasury, what we're basically seeing right now is this unwinding of everything that Janet Yellen did, right? We've talked in several different episodes, actually, about how she issued a lower percentage of bonds and notes out of the Treasury. So those are obviously the longer maturity debt instruments. And instead, there was this over-reliance on T-bills because they're traded more like cash. They don't carry as much of that premium when it comes to liquidity because they are so quickly going to turn back into liquidity. The longest maturity Treasury bill is 52 weeks. The shortest is only a few weeks. So they're traded much more like cash. At the same time, Powell took out about $1 trillion of liquidity from markets. Yellen added back in about $1 trillion of liquidity through this manipulation of the Treasury's maturity schedule. So, all this to say, much of the different movements that we are seeing right now when it comes to yields don't have anything to do with the underlying fundamentals. We're basically just trying to get back to normal. We're trying to get back to a position where these different indicators will tell us something about the fundamentals. And it's not just these yields. We're seeing it when we look at all kinds of different economic indicators, right? GDP, for example, as the government spends less money and as it hands the economy back over to the private sector, essentially, that's going to actually show up as lower GDP. It's going to make it look like the economy is contracting, even though it's actually good for the private sector. The private sector doesn't have to compete as much for workers, for products, for services, right? This is a good sign, except again, it's going to show up as a negative to GDP. And even the private components of GDP, when we look at something like what we call private consumer spending, that's been artificially going up because of government transfers. So if the government takes $1 from you and they give it to me and I go out and spend it, we don't count that as government spending, even though that's how it originated. It gets counted as private consumer spending. So you'll even see some of the private spending side, or the private side, I should say, of GDP, whether it's consumption, whether it's investment, that'll start taking a hit too as the government hands out less cash. So things that would traditionally be recession indicators unfortunately, they're just not really holding up. There's too much conflicting data coming in, right? We have plenty of signs from the market saying recession is coming. We have signs saying growth is coming. And that's been true for several years now. I mean, look at what we had in terms of not just GDP growth, but you can talk about job growth. At the same time, people in surveys were all saying, hey, I'm becoming poorer. The labor market data looked great. Yeah. Wages were going up. They didn't go up as fast as prices. People's lives demonstrably got worse financially. But, again, looking at these kind of broken macroeconomic indicators, things looked very positive. And the irony is going to be that as we reverse the bad policies that got us into this mess, as we kind of pull everything back, it's going to make those indicators go from good to bad. But it's going to make, I think, people's actual financial lives go from bad to good.
Okay, so a couple of things in there, which we've actually talked about. We were 6 months, well, at least 6 months ahead of the curve on this. And part of it is the privatization of the economy, which, and I'm quoting Besant now, which is fine, I'm not trying to copy him, but it's exactly what we've been talking about. And it wraps up a lot of what you just said. The government spending to prop up GDP, whether it's 50% of GDP or 60%. I've heard numbers as high as 70% of GDP growth over the Biden stretch was actually propped up by government spending, right? So that's increasing our debt, increasing our deficit, increasing inflationary pressures, and decreasing real production in the economy. It's a lot of jobs that really were not necessary, and a lot of spending that wasn't necessary. And as we have Besant come in and say we're going to privatize the economy, it's exactly what you're talking about, right? Starting to bring things back into order the way it historically has been, and to see real growth in the country, and to at the same time be reducing debt and deficits, increasing tax revenues, all these things that are better for the company. But we're going to see, as we've talked about for months, there is a spread and a stretch of time between the implementation of new policy and the end of cleanup. And that's really what we're looking at now. And for, whether it's Trump saying, hey, we're willing to take some hits and we're willing to have a little bit of a tough time to be better, or it's Besant saying, hey, we're going to privatize the economy and there's going to be some pain. This reset that we're going through, or even the tariff conversation, which is a conversation well overdue, whether we're talking about trade deficits and then the additional printing of money, which you've gone through before, which I didn't even know was a thing. Those trade deficits are actually bleeding into inflation. All this whole reset, this whole ball of crap that we're trying to reset is going to create pain. But what you're saying is, because it's so out of the ordinary and outside of the scope of how we normally measure, whether it be the twos, tens, whether it be GDP, whether it be personal consumption, there's going to be a lot of volatility and kind of rabbit holes and misdirection. But at the end of the day, we are heading in the right direction, but there's going to be just kind of misfires on signals that traditionally work, because we're coming out of a non-traditional period, which was the Biden administration and their policies. Is that fair to say in a nutshell?
Yeah, Anthony, absolutely. I'll use an analogy that doesn't really apply to either of us because we've never had this experience. But imagine you wake up one day having drunk too much the night before and you feel like total garbage, right? Never happened. I know. So this is kind of a stretch. We got to use our imaginations here. Okay. So, you wake up the next morning, you feel like absolute garbage, right? And you say, okay, I have a headache. Why do I have a headache? Is it because I stopped drinking? Do I just need to go back to drinking? Because when I was drinking, I didn't have a headache. I felt great then. Yeah. So this is, what you brought up, Besant, and this idea of detoxing. That's really what's going on. If you want to get back to actual health, you need to go through that painful detox process and not just go for more hair of the dog. That's not the solution. We've seen the result of moving the economy from sugar high to sugar high, or in this case, from one buzz to the next. Yeah. That's not the answer. That's how you get into this mess. That's how you get into this economic hangover, where over 4 years, people's average weekly paycheck has gotten 4% smaller. If you account not just for the growth in terms of dollars, how big the paycheck is, but what that paycheck can actually buy. People are worse off today than they were 4 years ago, right? You can buy less today than you could before. Look at home ownership. According to the Atlanta Fed, homes have never been so unaffordable since they started measuring it. I mean, that's insane. You can't tell me that's economic growth.
Yeah. Yeah, we've been talking about this for months. And just on the Island Capital side, I've been writing about it for months and trading it. And honestly, this has all been very well forecasted. And I said the other day, I was actually on Newsmax the other day, and they were asking me about the market, and I said, and tariffs. And I said, tariffs are, today's interchangeable headline. It's not that tariffs don't matter. It's not that it's not a real conversation. It is. But the bottom line is we're dealing with a market that's been over-levered, overextended, overvalued. We've had momentum and trend breaking down in not only the daily, but in December, as I started to call for a topping pattern, which no one was really looking at, but we started to see those momentum and trend indicators break down not only on the daily count, but on the weekly and monthly count. These are pretty bad things. These are things that happen at tops. And then we started to form this rectangular consolidation, which actually I think we have a chart of it coming up. I wanted to show kind of where we are currently on the weekly. This is the S&P 500 cash index weekly. And that red square at the top is the topping pattern that I started to identify in mid-December. And you can see that as we move bottom left to upper right, we had an upward trend. And this is really just high level, very general. And then as we got to December, we started to move from a vertical or lower left to upper right formation to a left to right formation, right? A more horizontal formation, which is fine. Depending on where that occurs in a chart, it could be consolidation and then continuation, or it could be consolidation and reversal. In my opinion, this was becoming a reversal pattern, which it has proven or is proving to be at this point, mostly because of where it occurred in the formation and because of what the underlying momentum and trend were doing at this point. So to look at some targets, and I'm kidding around, we were talking before, I had a good friend hit me last week who's at the largest hedge fund in the world and was asking me kind of what was going on with the market, because a lot of these guys honestly were born after 1990 and they've never traded in a real bear market. There's been some blips. COVID was a shock. It was not a bear market. There's been some moves down, and we could mark 20% moves down as a bear market. But having traded through personally the tech bubble in 2000 to 2002, finally bottoming out in 2003, having traded through the credit crisis in 2008, 2009, you start to become, you got some nicks on your armor at that point, and I feel like I do. So I have a pretty good view of what we're looking at and what it looks at like. If we look back, so we'll take our focus away from the upper right now on this chart. Look back even to 2022 of 2022. So like December through the bottoming out in September of 22. That entire move was down 27%. And we were nowhere near as overvalued or overlevered as we are now. And in fact, it was more of a coming to Jesus moment for the market. And if you remember at that point, the catalysts were Russia, Ukraine. The war was just starting, right? So we had geopolitical risks we hadn't actually counted on or discounted yet in the market. And we also had the Fed start talking about raising rates, which they guaranteed they wouldn't. Everybody had the Powell put in and the Fed put in, and that had been in for 20 years at that point. But they started talking about raising rates. So rates are going higher, and now there's Russia invading Ukraine, and we're entering what could be more of a global conflict. Market comes down 27%. That's fine. But just consider that the first move down in that 27% move down was down 14%. Then we had a 12% rally. Then we sold off another 16% or so. Then we had a 17% rally. Then we sold off 19%, finally bottoming out at that total 28%. The point is when you start to see movement in markets, or what looks like bear markets, or a real shift in sentiment, or a real reallocating of assets and a re-gauging of risk, it's not a straight move down. Now, what we're doing now feels like that, but it's not going to be that in the end. So we go back forward to 2023, we had a quick 10% correction, bottoming out in August of 2023. That's right dead center of this chart. No problem. That was pretty quick, pretty much to the point, just a flush out of the market. Happens about every 2 to 3 years. Not a problem, natural, fine. As we came up to the top now, we really started to get overextended, and I would talk to technicals more, but I'd like to note, which I already have, I think, enough. I'd like to note that, and we talked about this months ago, the inflation-adjusted Shiller PE for the market at its top, at its recent peak, was second only to the tech bubble reading of 44. We were at about a 38, 39 at our recent top. So we were way overextended on a cyclical basis as far as PEs. And then you can talk about the breakdown in technicals and leverage and all those things. So we had a quick move down 9% in June into August of 24, right? And then we got this nice, from that low, along with the election rally, we had a 20% rally up to the top. Now, we've gone through the retracement levels. We've gone through the formations and the patterns in past episodes. This really was a long-term resistance level, which people weren't acknowledging. We also saw a ton of lack of conviction and volatility at all-time highs. And I've said that verbatim 1,000 times. When you see lack of conviction and volatility in markets, it's fine. You're moving through the market. You're working your way through. When you see lack of conviction and extreme price volatility, not VIX, because VIX was pretty subdued at that point with good reason. People didn't need insurance and weren't really expecting the move we've seen. But when you see lack of conviction and price volatility at all-time highs, that's a negative. Example, the DeepSeek 3% dip down overnight because all of a sudden there's a new AI model that might blow it up. China on a Sunday night saying, we're going to come back, we're going to combat tariffs. We have our own tariffs and our own response. Boom, S&P down 2.5% overnight, only to rally back towards that high price volatility. What we've seen now is we've seen a move down to close to 10% coming off of that peak. And that's that breakdown at the end of the red box, that rectangular consolidation or that topping pattern. 10% is the correction level, the generally accepted correction level. And that's fine. And I'm sure everyone, when it was up at 6,000 and I was saying in the report and talking to guys saying it's going to be 5,500, 5,000, I was almost getting chuckled at. Now people are actually hitting me and saying, hey, what do you think next support level is? So my view would be we're down 10% in a pretty aggressive move down. And part of that is the tariff concern. Part of that is the market was ready to make a move down. And part of that is the administration, in a very big boy way, in a very Trumpian way, is saying, listen, we know there's going to be damage. We know there's going to be pain. It's time to take our medicine. And whether that means the market comes in or whether that means we head into recession, overall, we're doing the right things and we're the adults in the room now. So we're going to continue to do the right things. These are things that administrations, politicians, and presidents don't say normally. But Trump is saying it. Besson is saying it. We have a group of very transparent, very upfront, and very intelligent people in the White House and the administration, along with President Trump. Not afraid to break a few eggs to make the omelet. And although eggs are very expensive right now, thank you.
I will never financially recover from this.
So we're looking at a 10% move down to 5,500. I would expect that we could see, and I continue to write in the report, be conscious of these snapback rallies, these bear market rallies. I don't think this is just a correction, but I would expect the market to start to try and buy the dip, because that's what we've been drilled to do since 2000, start to cover shorts. The CTAs, the commodity traders, are always based on technicals, trend, momentum, reversion trades. That's going to start to pop in. So you'll see rallies off of this level, the current level, and it may be down 5% from here. It may be right here. I don't know exactly, but I do know, and I've continued to say, that all of these rallies are to be sold and not chased. And I actually wrote that back in December, and I continue to stand by that. A case in point, I have sold and not chased these rallies since I identified this as a topping pattern. And we've had a phenomenal year. We've, as I said, we're up 12% or so, 11.5%, 12% at this point year to date. And since last June, when I start my fiscal year, we're up over 50% now on capital. So it's been a very productive year for us in working through the motor model, my momentum trend model, and trading the technicals and not getting bogged down in all of these other headlines and stories and rabbit holes. I do think we're due for a bounce at some point relatively soon. And I do think we will hit 5,000. So broader picture here, 5,000 from 61 and change is going to bring us down about 20%, a little shy of 20%. I think that is a very easy target for this entire cycle to flush out. Now, whether we get back to 6,000 or 5,900 or 5,700 before that, we may. And it's something to be very conscious of because that's the way markets act. But I would say that right now we are seeing a breakdown in daily, weekly, monthly indicators. My model is hardcore negative. We are seeing almost a 10% move out of a consolidation, which is a intermediate term consolidation at this point. We're going on 5 months. So that's becoming more relevant. And I do think we have another 10% from current levels down. So call it 5,000 for a round number. How we hit 5,000 and how we act at 5,000, momentum, trend, breadth, volumes, volatility, all those things will then lead me to start marking down lower targets, down 30%, down 40% from peak. But remember, down 30% is nothing. We were down 57% in 0809. I'm not saying it's 0809. I'm just saying we have seen bear markets that have taken away more than 9.7%. And I think that's where we are right now. That's the market we're in right now. So just be prepared for snapback rallies. Be prepared overall for lower lows.
All great points, Anthony. If I can just kind of add one thing on before we close, you made me think when you're talking about how so many, whether it's money managers, brokers, traders, just all the folks on Wall Street just haven't been around long enough, too many of them at least, haven't been around long enough to remember a true bear market, right? Yep. Well, I think on the policy side, the exact same problem is that all those folks have ever known is this whole mantra of free trade. And they were literally taught in school, no matter what the other person does, the other nation does, don't put up any tariffs, don't put up any other non-tariff barriers. Tariffs can't be used as like a negotiating tool or a bargaining chip or anything like that. They were raised on NAFTA. And this is nonpartisan, right? This is both sides, Republican and Democrat, the Keynesians, the monetarists, neoclassicalists, everybody. So we're kind of having to relearn, I think, to your point, not only what is a bear market, but what about tariffs, right? Yeah. People are having to reconsider all of these policy proposals as well. And hey, take advantage of these dips, right? If the market's going to sell off as your model has been indicating, the headlines are interchangeable, like you've been saying. And if they're going to use this as the reason for to enter not just a correction but a bear market, so be it.
Yeah, it's definitely it is. That's a really great point. And I didn't think about that. I mean, I'm obviously trading for 30 years. So buy side, sell side, I have friends across the board and speaking to people every day. And the view is there's a lot of, and let me be very clear, a very, very, very intelligent, capable people sitting on desks as portfolio managers and traders, but they just haven't had the real world experience just simply because of age. And I didn't realize that on the policy side, the same thing, the academics coming out and starting, and now who are the workforce on the policy side have not seen or have not been taught to look at things kind of in this way. And we're kind of there. It's the real world is very different at this point.
Yeah, exactly. Well said.
All right. Very cool. I think we have 1 minute. We have one clip this week. How dumb is, I have to run it. I know we have about 30 seconds. But let's go to the videotape on the How Dumb Is segment.
40 acres in the mule. This is bigger than the music. Yeah, they tried to rig the game, but you can't fake influence. Hey, I'm tripping, I'm sliding, I'm riding through the back like buck. Mustard on a beat, bro. Deep boat, any rap. He a freak.
It's an elected official, by the way.
Tell him breathe. Let them boys to the cross, they walk around like peas.
Proposing a legislation.
It is not a criminal violation to enter the country illegally. It's not a criminal. It's a crime. It's not a crime, which is why they're so frustrated, because they really want our local law enforcement to go out and round up people when they could be looking out for the murderers and the sexual abusers as well as the robbers. They want them to go and round people up on civil accusations. And so
it's pretty, I want to try and laugh at these things, but I mean, how dumb could you be? And
apparently that dumb. Oh my goodness.
And if you're dumb and you know you're dumb, it almost makes you smart, or hopefully smart enough to not do stuff like that. But so that's an elected official, Congresswoman.
Yeah, an elected official who unfortunately is not smart enough to know she's stupid.
That's it. All right, my friend. I know we are pressed. We are done. Great episode. Appreciate the insight as always, and I will speak with you next week.
Till then, Anthony.
Thanks, man.